Thanks for tuning into Investors Guide. I'm Avni Raja. This is a show where we help you understand the basics of financial planning. And over the last few episodes, we've been talking all about mutual funds, giving you a step-by-step guide on how to start investing in mutual funds. And on today's episode, we are going to specifically talk about the two options that you have when you invest in a mutual fund, that is the growth option and dividend option, what it means and which one makes sense for you. And to put all of this in perspective, joining me as usual is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thanks so much for joining us on Investors Guide. Let's talk about the growth option and the dividend option, because every fund or at least most funds have these two different options whereby investors can choose which one to opt for. Now, let's first start with understanding what really is the growth option and what it really means in terms of the fact that investors have to understand that they will not get any regular payouts if they choose a growth option.
The growth option is, as the name suggests, is an option where the fund manager keeps compounding the money and keeps growing the money without actually paying it out to the investor. So if I put 100 rupees in a growth option and I leave it for 10 years, there will be no payout into my bank account, irrespective of the gain the scheme ended up making. For example, if the 100 rupees I invested in 10 years became 300 rupees, the entire 200 rupee gain is pumped into the NAV. And increases, the NAV increases in value rather than at a regular interval or even at an ad hoc interval being paid out to the investor. So growth option, you will not or cannot expect inflows from the components of gain which the fund manager makes on your behalf over the course of the investing life. And on the dividend option, as the name suggests, as the NAV goes up, the fund manager actually pays out a portion of the gain he or she as a fund manager has made for you in the form of a dividend into your bank account. So if you take a dividend option, you can expect some inflows at a regular frequency in the case of a debt scheme, at an irregular frequency, at an ad hoc basis in an equity scheme. But you will be getting some inflows in your bank account. So that's why it's called a dividend option. And the growth option has no inflows whatsoever.
Right. So the most important difference here to be aware about is the fact that if you opt for a growth option, the returns are likely to be slightly more than the dividend option simply because the money that you get, the dividend that you get, that's actually taken out of the profits that this particular fund makes. And in the growth option, that money is simply reinvested, whereas in the dividend option, that money is paid out. So end of the day, it ends up impacting your overall total returns.
Avni, I think you're absolutely right. If you take a growth option, especially long-term investors, they will get a benefit of compounding, which is also called the eighth wonder of the world, which is nothing but growth on growth. By which I mean, if you've earned something, if that portion of your earnings also begins to earn for you, that's compounding. So because in a growth option, you're getting no payouts into your bank account, the money which has grown will further grow. That's why there's power of compounding more in the growth option. In the dividend option, if you put 100 rupees as an investment, if you've got 2 rupees out every quarter in a debt scheme, that 2 rupees might just get languished in a bank account and not grow for you further. So growth option gets the power of compounding, especially for long-term investors, especially in equity schemes. Choosing a growth option is a very wise alternative because equities in the long run give you 12-14% return, and compounding becomes far more powerful in an equity scheme. And currently, if you look at dividends, they're no more tax-free and they're going to be taxed at source. So it's always a better alternative to go for the growth option because it gives you compounding and also tax efficiency in the form of deferring the tax till the time you actually take the money in your bank account.
Yes, absolutely, Feroze. That's a very important point, because now with the dividend that you get, you have to pay the tax as per your income tax slabs. So obviously that benefit that was already there, that was used to be there earlier, that's completely gone. And on top of that, it's going to impact your overall returns as well. So, it's not really the best idea unless somebody actually needs that income, needs that regular cash flows to sustain on a regular basis. So Feroze, that brings me to my next question as to who should be opting for the growth option and who should be opting for the dividend option.
To my mind, Avni, as things stand today, if you look at a growth option, a person in a large tax bracket, highest tax bracket, should always choose a growth option, both in the equity funds and in the debt schemes. But a retail client who's not in a very high tax bracket, that's the highest tax bracket, if he's not in the highest tax bracket, he should choose in the equity side a growth option. On the debt side, he can choose a dividend option. To my mind, both on the equity and the debt side, dividend options are now redundant. They were very relevant a few years back when the tax laws were different. But today, to my mind, dividend options are practically redundant, and you should always choose a growth option. If you're in the lowest tax bracket, maybe you can consider a dividend alternative. Because even if you want a regular income on a monthly basis, there are other alternatives available in the mutual fund category, which is called systematic withdrawal plan, for a topic for another day. That can help you get tax efficient, consistent cash flows in the bank account.
Right. Right, that was going to be my last question, Feroze, in terms of, what should one do? Of course, we will discuss it in detail at a later stage, but for those who are watching this right now and realize that it's important to sort of use the growth option and not dividend option, and if they are those who need that regular income, some points that they should sort of think of at this point in time.
So, to my mind, if you have a need for a regular income, for example, if a person is just retired, he has a retirement corpus, which he invests in a debt scheme, he would be very tempted to take a dividend alternative, but that's going to be tax inefficient because there will be dividend distribution at source, tax at source. So you choose to put in the growth option and parallelly have a systematic withdrawal plan activated on a predetermined date with a 1 month frequency, so that on that specific day you get a credit. If that's a holiday for a particular month, then you get a credit a couple of days later. But consistently, month on month, you can get a credit for as long as you want. So buy a growth option in the debt scheme and complement it with a systematic withdrawal plan. That will be very tax efficient because the entire amount that you get in your bank account is not taxable because it has a capital and an interest component. Only the interest component gets taxed, and your overall tax after holding this combination for 3 years should be 7 to 8%, not 30%.
All right, Feroze, we'll leave it there. Thank you so much for putting all of that into perspective. And for our viewers, I hope that helped you understand the difference between growth and dividend option and puts it into perspective as to what you should be choosing when you decide to go ahead and start investing in mutual funds. We'll be back with yet another episode with another aspect of investing in mutual funds. Until then, thank you so much for watching.